When it comes to trading the Forex, it becomes essential for traders to predict the price movements before making any trading decision because of its highly volatile nature. To make predictions of future price movements, they use indicators and technical tools. One such commonly used tool is the candlestick pattern. This pattern indicator helps traders determine the direction of prices in the Forex trading chart by considering the preceding price patterns. This indicator is beneficial as it helps the trader recognize the possible highs and lows in the price chart along with the predicted opening and closing prices. But the predictions shown by the patterns are not precise. This is mainly because it is based on former patterns in the price chart, and there is no certainty that the nature of the market will remain the same or if it will repeat itself. Also, many types of candlestick chart patterns can occur on a Forex price chart. Therefore, it is not expected that traders, even expert ones, will recognize all of them completely and correctly. To help traders recognize a candlestick pattern more accurately in real time, they can use the Pattern Recognition Master Indicator. The Pattern Recognition Indicator, or the Candlestick Pattern Indicator, is a real-time indicator. It helps traders recognize which candlestick pattern is forming and where on the price chart. As the patterns include, along with the movement of the price chart, it prompts the formation of these patterns with the help of some alphabets. These alphabets are prearranged, and different pairs of alphabets symbolize another type of candlestick chart pattern. For example, if you spot the alphabet LE on your chart, it shows that a bullish candlestick pattern is forming. Similarly, an SE offers the start of a bearish candlestick pattern. How to use the Pattern Recognition Indicator. This indicator helps you recognize different candlestick patterns forming on the real-time trading chart. So, to make efficient use of this indicator, traders must know different candlestick patterns and understand what these patterns signify. If they are well aware of the significance of each pattern, they will be able to take quick actions as soon as the pattern forms. Another critical point to understand here is that traders must not rely on this indicator alone while trading Forex or any other asset. Instead, it is essential to use a set of indicators and analysis tools that can complement each other's predictions. Candlestick and chart patterns are a huge part of many Forex trading strategies. These patterns are created by predefined price movements, and the movement after these patterns tends to be repeating itself. There are a lot of different chart and candlestick patterns, and each of them has its own specifics and rules about how to trade it. The biggest problem with these patterns is, however, to spot them in time. This is where it is great to use an indicator such as the Wedge Pattern Indicator for MT4. This indicator searches for the wedge pattern and draws lines on the chart to visually show it to you. The wedge pattern is one of the most popular chart patterns. There are two types of the wedge pattern, the rising wedge and the falling wedge. Both these patterns are formed by two converging trend lines that connect the highs and lows of on the price chart. The wedge pattern is typically very good at predicting future movements and thus can be used to find good trading opportunities. Typically this pattern consists of 3 steps. First, either the rising or falling wedge pattern forms. Second, we see a decline in volume, and third, a breakout of the trend lines. Because of the second step of this pattern, many traders use it in combination with a volume indicator. This indicator can also spot how the volume starts to increase when the price finally breaks out of the pattern. The rising wedge pattern is normally created after a longer uptrend and signals a reversal to the downside. Above you can see an example of the rising wedge on a live chart. We can first see the converging trend lines that connect the lows and highs on the chart. As the pattern continues, we can now also see that the volume is declining and finally starting to increase again at the breakout point. At the end, price breaks the pattern to the downside as we have expected. This breakout can be traded very well. If you are a riskier trader, you can already trade the first breakout. But if you want to be a bit safer, it is wise to wait for price to pull back to the trend line and then trade the continuation that will very likely happen afterwards. The falling wedge pattern does the exact same thing as the rising wedge, but everything is switched around. This pattern normally happens after a longer downtrend, and the typical outcome of it is a move to the upside. Above you can see exactly how this pattern develops and how it predicted the future movement very good from these two examples.